Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Adrian Nicholson, and we've got a great episode for you today, hoping that we can help you plan out and get prepared for 2024 as we close out 2023. Adrian, how's your 2 weeks been now that we're recording every other week?
My last 2 weeks been great. I'm fired up. I always enjoy having this type of topic to discuss with you today, Roshan. So I'm looking forward to our conversation. I hope it's helpful for our listeners and viewers.
Yeah, I think this is one of those I like as well because I think we're going to give useful information that's actionable, and hopefully we can help you towards your goals in this episode by helping you with the investment side of things.
Yes, exactly. I agree.
So let's jump right into it. We're talking about the 2024 market outlook. Are there any themes or areas that stand out for you as we get into 2024?
I guess I'll start off with this line saying that with any year, really, you have to balance risk with optimism. And I think that's a good way to kind of line out how this episode is, because with every new year, there are new risks that investors have to always be aware of and on top of that can impact their investments, their assets, their portfolio. And with that, having a healthy dose of optimism, always, being hopeful, looking forward to better times, hopefully, everything companies, areas, everything just remains resilient. So having a healthy balance between risk and optimism is a good way to start out with a new year approach when it comes to looking at how the markets are going to be.
Yeah, I think it always comes down to managing risk. So I completely
hmm
agree with you.
hmm Yeah,
Uh,
and definitely with how the last couple of years have been, there have been a lot of new risk out there that investors maybe weren't expecting going to the year that came up. So that's why I think it's just awesome just to have this conversation, this discussion. Of course, it's going to be hard to predict everything that's going to come our way, but just having discussion, planning it, talking about it, just seeing how you can just position yourself the best way possible is always a good route to take.
yep, yeah, and let's actually go into one of those risks. That's what I've got on my list as a theme is inflation. That's
hmm
been a topic of conversation now for roughly 2 full years. I think at the November 2021 is when we first started to see it. It might be as far as 3 years previously that we've been going into it, and the expectation we're seeing with inflation is it's starting to slow. It's gone from over 9% to under 3.5. So it looks like it's heading in the right direction and slowing down. What are you seeing with inflation? Any thoughts, ideas, anything at all in that with inflation as being the theme to start?
Well, you mentioned it. Inflation has come down. I mean, not to the level that the Fed want it to be. As people probably know, the target is around that 2% neighborhood. We're not there yet. And a lot of people talk about it. It is easy to get from a higher number of inflation down to where we are now, but that extra point down could be a lot more difficult. But again, over the past couple of years, the Fed has done a good job getting inflation down. As people know, one of their biggest tools is the interest rates. So having higher interest rates, that's also probably something we're going to touch on as well. But I'm right there with you. Inflation has come down, and that has helped out consumers, businesses. I mean, you name it. We're definitely going in the right direction headed into this new year.
Yeah, there are a couple things. I think this is a great time to give our disclaimer. This is all for educational purposes. Please consult with your advisor. This is not advice. We're just here to give you some things to think about and some ways you can um, approach your portfolio to try to reach your goals. We're not suggesting making changes or adjustments. Speak to your advisor or contact us if you need help. We'd be happy to discuss it with you. Now that that's out of the way, where do you see? First, I'll give you one thing I thought was interesting. We talked about this on a previous episode with Eric. I believe this was back in May or June of this year, 2023. But shelter inflation currently accounts for about 3/4 of the year over year CPI increase. And
hmm
most of the data suggests that it's cooling, uh, which is leads to the thought of lower inflation out there. The next thing, though, is what are some themes or some things you can do to try to take advantage of it? Do you have any thoughts in that area of what where people can be looking or researching to try to take advantage of this if they are in the camp, as I am, that inflation will continue to cool?
Well, I just think of ways of battling inflation. So maybe you can go into that, and I could talk about ways to make sure that people can keep up with inflation if that's still something that they have concerns about and may think that the Fed might not be able to get to their target or it could tick back up. Because again, this is all contingent on everything being normal going into the new year, no big shocks or nothing where inflation picks back up again. So I think that's my take on it for right now.
Well, let's start with what you've got, and then we'll go into to areas I would suggest you look into, just because I think they might line up. So, what are your areas of what people should do for inflation, or if they're concerned about it continuing to go up?
Well, that you got to take a look at your portfolio and just seeing how that is going to keep pace with inflation. I mean, we had an episode called The Building Blocks of a Portfolio. And as we know, people's portfolios are made up of a variety of different things. I'll just name three common ones that come to mind: stocks, bonds, and cash. And right now, where I mentioned where the Fed has raised interest rates a lot higher now, there's a lot more opportunity for people to get creative and look at different ways that they can structure their portfolio to beat inflation. Again, with higher rates, people could get more yields on their bonds and their cash. And then stocks is always a good place for people to look at as well. Obviously, going into the new year, this is where we really have to look at where you're invested, what your allocation is. Are you over allocated maybe to one sector or one industry? That's where we can have a conversation about diversification. But these are all ways that you can look at beating inflation if that's something that's a top of mind for you or a risk coming into the new year.
Yep. I've got some similar things. First, you had mentioned a place to look at are equities, in particular,
Mm,
large public companies. They've been able to maintain margins and pricing power. So if they can pass on any inflation. Another data point saw in JP Morgan's outlook, which I really, really liked, was they had said when inflation is between 2 and 3%, the S&P has averaged nearly 14%. And
wow,
that's the
that's interesting. Yeah.
expected range that we're going to be in, right now at about 3.5. So we'll be dropping down to that 2 to 3 range. That was a good one. Excuse me. Another one that I'd like that I'd seen with JP Morgan and definitely a few other area firms as well. This is almost a standard as well, is real assets, real estate, infrastructure, transportation, commodities, and timber were
Hmm.
listed. So just areas to research and look into are equities and those real assets. And as I said earlier, this is not advice. Please contact your advisor or feel free to reach out to us if you need help.
And you just mentioned margin. I think that's something that investors should really be focusing on coming into the new year, especially margin expansion. I mean, depending on what the Fed does with interest rates, if they cut, if they keep them higher for longer, that's just going to impact companies' margin. And whether they're expanding or contracting, that's something you really have to look into, especially if you're over allocated to one specific company and you're not heavily diversified. How are companies, businesses out there going to respond if rates are higher for longer? So that's also something where I think you really have to look at and consider going into the new year.
So, Adrian, do you feel mind explaining margin expansion?
It all breaks down to just companies' profitability, how much money's coming in the door and how much money's going out the door as far as cost, day-to-day operations, and at the end of the day, are they profitable? Are their bottom line numbers positive? And again, with higher interest, you have companies, let's just say you have a company out there that has a lot of debt or needs to refinance debt and they're not managing their balance sheet very well. Or higher rates can really eat away. Let's just say they have great revenues and they make a lot of money. A lot of that debt and liability and those higher interest rates can start eating away at that cost. So it's really, you really got to dive deep into the numbers. I know that can be complex for a lot of people out there, but the concept is really going to be seen throughout. Just how are people, businesses, well, I mentioned people and businesses, how are they going to withstand these higher rates when it comes to their bottom line at the end of the month?
Yeah, I saw when you talked to margin expansion, I saw something in a similar space, a similar explanation where they had said uh, U.S. large companies went through an earnings recession between 2022 and 2023. Which is three
Mm-hmm.
consecutive quarters of earnings decline. 9 of 11 of those sectors have gone through it, and they
Wow.
are now leaner. Right. So when you talk
Mm-hmm.
about margin expansion, as you explained so well right now, well, now your costs have gone down, and partly due to inflation what you're charging has gone up. So you're
Mm-hmm.
able to have a greater profit margin, which would lead to uh, good opportunity for stocks, leads to greater earnings, and stock prices typically will follow earnings. So that is an explanation as to why uh, the why the stock market or equities would be a good place to potentially turn to, particularly if inflation stays roughly where it is. Corporations can charge what they were charging; they're just able to do it at a lower cost.
Mm-hmm. Yeah, exactly right, Roshan. I definitely agree with that.
Do you have another? I've got another theme for us actually, and feel free to jump in with one of your own. This also, thanks to JP Morgan and Goldman Sachs gave some great information too. But um, cash rates look good.
Mm-hmm.
Cash you're getting, CDs, money market rates look good. However, have they peaked? Is this an opportunity to, if you're locking in something for interest rates for a little while, is this an opportunity to lock into it, or is it the opposite? If you've got things that are maturing or cash just sitting out there, should you look at repositioning that? So what are your thoughts, or what have you seen with the cash portion of the portfolio?
Mm-hmm. I mean, I definitely like the cash position or portfolio as long as you're strategic about it. Really view it as we go into the new year. Maybe this year you took more of a caution approach and really built up that cash portion of your portfolio. Maybe you are earning a decent amount on that. But going forward, you just got to know there are opportunity costs that come to it. I mean, we don't know. It's hard to predict where stocks and bonds are going to go next year, but that's something that you really have to plan for and be strategic about if you're willing to just lock in a certain amount of it and just giving up whatever stocks and bonds may do. I mean, it could be profitable for you or not profitable, but being strategic and evaluating it going into a year is extremely important here.
Yeah, I'd agree with you that what you've alluded to is planning, building a plan, making sure your investments are around
Mm,
your goals.
mm,
I think that's very, very true and very useful for everyone listening, particularly when we think about the time of the year. It's a New Year is a good time to plan out your goals. I can't remember I think the number was something like 70% of people have a goal related to finance or weight loss. So it
mhm.
just seems like a time people are thinking about finances and planning out the next year. So making sure the cash portion of the portfolio aligns with where it should be. Interestingly,
Yes.
I was speaking to a client yesterday who put a bunch of money in CDs a year ago, and for his long-term retirement goals, he's got too much in cash. Right, it's just not going to perform as at a level he needs to accomplish his goal. So that's just an example, a recent example that I've seen about cash, which we're talking about, and about
Mhm,
planning, which we're
mhm.
talking about. So planning out your cash, I completely agree with. I think you've got to, when you think about this, if you take out the planning and you just think about this as a portion of your portfolio, and you're thinking more strategically with the cash, I think you've got to have a thought on which way interest rates are headed. Do you
Mm,
expect
mhm.
any additional rate hikes, or do you expect cuts? If you expect rate hikes, you'd want to go shorter term with your cash and then lock it in the longer term after the hike. If you're expecting cuts, maybe you lock in your cash longer term now. Once again, making sure it aligns with your goals. But if you believe that we're going to have rate cuts at some point next year, as I do. I think it's going to be really late in the year, maybe second half for sure, maybe for fourth quarter is what I'm thinking. Well, then if you have a CD that matures, uh, and the markets are expecting a rate hike, well, that new rate you get for your CD will be a little bit lower. So, thinking about your cash, how it lines up with your portfolio, and what to do about that cash, I think is it's a good time of year to do that. I say time of year. I should also actually clarify. It's a good time in the rate cycle for you to consider that.
And now let's just throw bonds in that mix as well, because they do sometimes play a similar role with getting a decent rate now with higher interest rates as well, and how that plays a part in the portfolio. What's your opinion on that?
A great segue, Adrian. That was the next theme I had as well. That bonds are and looking at them with the portfolio. A
Hmm.
few things that I saw that were interesting. One is uh, a lot. You've seen yields are higher in bonds, money markets, CDs, whatever. Just everyone that's looking at these things, you're seeing that yields are higher. They've gotten to the to rate levels we haven't seen since 2007. uh, well, bonds may present a good opportunity, particularly longer term bonds, because if rates are cut, there may be additional growth there. One of the numbers I saw was that if the 10-year treasury, if rates fall by 1%, the 10-year treasury will typically gain around 12%. So that's just a massive gain for a treasury, and then it's paying you roughly 5% as well. So
Hmm.
there may be an opportunity or opportunity out there. Another thing I saw while researching this is that the typical investor has not adjusted their allocation towards bonds after these rate hike cycles. So this may prove to be a good opportunity for those listening. Do you have an opportunity in this space? Are there things you can take advantage of in this space? So I think similar to the other areas we've said that are worth researching, like equities in general, looking at large companies, looking at real assets like real estate, commodities, etc. I think you've got to put bonds on your list of something that may be worth your time to research.
Yeah, I agree with that, because when people hear the word diversification, I sometimes think they gravitate to the idea of like stocks, equities, having like different companies, but it also applies to bonds here. The type of bond you have, far as the time frame of it, is a year, 2 years, 5 years, 10 years. How far out is it? Who's backing the bond, the credit of it. It's all something that you have to look at here, and it's not just as uh, it could be a very complex, or it could be simple. But just looking at the type of bonds you own and diversifying in that is crucial here, because a move in interest rates, if you're over allocated to one type of bond or one certain group, could have an impact on your portfolio. When typically people think of bonds, they think of it as a safe part of their portfolio.
Yeah, and what you had said earlier too, I was thinking about it when you had mentioned companies and different
Hmm.
corporations and the different risks out there. The goals that you mentioned earlier, you can line them up with the bond. What I mean by that is if you know, for example, you're planning for your child's education, right? And let's say you've got a 14-year-old and freshman year was 4 years away. It's worth researching, are there bonds out there where you can lock in a pretty good interest rate for those 4 years, and then the bond matures when it's time for the tuition payment. So if there are
Hmm.
any other goals like that, buying a retirement home first year of retirement, or buying another home. I said retirement home, but it could be uh, re- moving from your home to another home for you, a second home. There are any of these goals that typically lock into a time frame, the first year of retirement, it's an area, especially when you're looking at the shorter term, where it is very much worthwhile to research.
Hmm. I agree with you, Roshan. Yep, well said.
Next, I've got this was a category, a subcategory in the equity space, or just some trends that could potentially generate out performance. So sticking with our goal here of trying to give you areas to look into to improve your performance or for opportunities. There are a few that came up, and I believe this was the JP Morgan Outlook, which, by the way, you can get that for anyone listening. If you'd like, you can get that JP Morgan 2024 Market Outlook literally by a Google search and going onto their website. It can just be downloaded. Um, and so it's called, I believe it's called Market Insights. So it's a good read. I think it's worthwhile. We've gotten some ideas from there, but they had some trends or themes to look at in the equity space. They had mentioned, and this is a one that's been talked about a lot for this year, but AI, artificial intelligence. Had an example in there of they have an AI model that has been able to outperform an expert radiologist at spotting malignant pancreatic cancer. The other theme they had mentioned on there are these GLP-1 weight loss drugs, which, if you've been listening or looking at the investment world in general, there's been a lot of talk about these. Just an example that was given is the costs are high. One of these drugs, Manjaro, is $1,000 a month, and they contrasted that with Shelter being about 650 per month per capita for the top 25% earners, meaning you'd be spending more on Manjaro than you're spending on your rent. And
Mhm.
the opportunity is huge. Current market looks to be 6 billion, and they think it's going to be 100 billion by 2030 in the United States, with over, we have over 100 million obese Americans. Other theme that they mentioned: infrastructure, construction, and defense. I think just what's been going on, here in the United States with the bills that have been passing, and our infrastructure is getting old and needing to be upgraded. There's a huge opportunity there. And then with what's going on globally, uh, it makes sense that defense spending's up. So those are some themes when you're researching that may be worth looking into in the equity space.
Mhm. Yeah, I like all those themes, and it just goes back to what I said about balancing risk and optimism. Where this is really optimistic, where a concept I heard or line was compounding innovation, where we are having these new technologies, these new drugs, this new innovation that's starting to be on the forefront that people are starting to take note of and incorporating it into their business as well. So there is a lot to look forward here. But again, you have to have a healthy dose of risk and not letting your optimistic just get out of hand, and just really monitor these things as they come up, because there are some good things out here for companies that are going to generate money for them, innovate them, help their businesses grow. And some are going to be winners, some are going to be losers. But again, this is something that you have to always research and be aware of on top of it. And that's why I like having these discussions, just having these conversations on what potentially could be the next big opportunity out there for our listeners and our investors. So I definitely like all those
Yeah,
themes that you draw up, and there is some good opportunity there.
yeah, and as you said, we've referenced your plan, your financial plan earlier, and a big component of that financial plan is managing, first understanding your risk
Hmm.
and then
Hmm.
managing it. So yes, do your homework on these ideas, and then see how these ideas fit within your risk tolerance, and then see how that your investment portfolio and risk tolerance fit within your overall portfolio.
Hmm. And so we did outline one of like the main risk out there, as far as just inflation. What are some other ones that you're seeing out there, or concerned about, or should be at top of mind?
One other one mentioned out there that we've also just seen with what's going on in the markets is the potential credit risk.
Hmm.
Not that it's expected to be as bad as the financial crisis back in '07 or anything like that, but there are some sectors, commercial real estate, with people, work from home still exists. So you've got you've got, depending on where you're looking, you've got vacant office buildings, so commercial real estate loans, um, in particular. If they can't, the owner of the property can't refinance or can't afford to refinance the higher rate. Same uh, with the consumer. Auto loans, credit cards, can they continue to make these payments or charge up their cards? Savings numbers have gone down a lot over the last few years. Uh, on the corporate side, that applies to high yield corporate credit, which are companies that typically have a lower credit quality. And then you have the risk with small companies that rely on debt, because if they rely on debt and they need to refinance at higher rates, are they going to be able to stay in business? Are they going to be able to afford it? So it's
Hmm.
it's few areas where a risk could be. We mentioned inflation. Now we're mentioning credit risk.
Hmm. And I think too, that's also something that people should consider as well if they're looking at private markets as well. I know that can be very different or selective depending on what the investment is, but that's also something too that gets impacted depending on just the liquidity that's out there, what credit is like. That's something too. If that's something that you're looking for different opportunities just to add to your portfolio or your allocation, I mean, there always is opportunities, but again, it might be limited depending on how next year looks, far as if rates stay higher for longer, if there's less liquidity out there, less risk taking. That's something too that you have to look at if you're looking more in the private sector as well. Because I mean, I do think the private sector is very vital as well when we talk about those themes and when it comes to innovation and funding. So that's something too that has to be on top of mind as well for these things to progress in the future.
And with innovation, you mentioned, you use that term. I think that's where that AI theme, which has continued this year, is still a huge innovation opportunity, and we're
Hmm.
we're still at the early stages of that innovation.
Hmm. Yes.
So I completely agree with you on that. So what other thoughts or themes do you have? We've exhausted my themes, although I do have some other interesting notes or points that I gathered while preparing.
I guess maybe we can maybe take a step outside because typically when we're having this conversation, we tend to focus more on like US stocks, bonds, and then what's going on with cash bars, interest rates here. But maybe we can take a more of a geo look and just maybe look at other areas as well, because I know that's a significant factor. Maybe some people are looking to maybe far as their equities or their bond portion of the portfolio, maybe looking outside of the US as well, just to see if there's any opportunities out there. What would be your initial thoughts on that?
Well, I'll tell you what I saw that made a lot of sense was that uh, the S&P people are arguing, is it overvalued on a price to earnings
Hmm.
basis? And the comment I saw was that the S&P may be slightly above average right now, but mid cap, medium sized companies and small cap, small sized companies appear to be uh, more undervalued, as do European emerging markets and Chinese stocks.
Hmm.
So, from a global perspective, there may be opportunities there. It's definitely worth looking into and researching uh, globally as well for, as you mentioned earlier, Adrian, balancing the optimism and the risks. So maybe for a portion of the portfolio, it's worth researching and seeing if there's an opportunity in those areas.
Yeah, because I got to imagine the risks are different out there. I mean, you mentioned Europe. I mean, that's something too where their battle with inflation is kind of very similar to ours, but they, are closer to certain issues and conflicts, especially geopolitical conflicts as well out there, like what's going on with Israel and Gaza and in Ukraine. That's always something that's on top of mind with everybody right now that can impact them too. And then you mentioned China as well. I know one thing that comes on top of mind with that is the real estate market right now. So that's also something that you have to consider if you take uh, a step outside the U.S. The different risk factors and different things you have to look at may vary and may be different.
Yep. Yeah, that is for sure. And with Europe, one of the other things um, that I saw in another report, I think this was with Goldman Sachs, which also for everyone listening, if you Google that Goldman Sachs 2024 outlook, you can find it pretty easily. But they one of their arguments for growth with Europe and the UK was that the Russian gas shock continues to fade, so there's an opportunity, or that should help with growth, I should say, in Europe and the UK.
Yeah, and I guess one thing I was researching, I haven't came across this term before, but I think this could really impact how 2024 would be. Is it's saying if anti-globalization is going to progress, where I guess different companies and different regions just are less and less inclined, or take a lot more for them to come to the table to create, better regulation, fair trade, and something. So that's also something else that, depending on how that works out, can really impact markets as well.
Yeah, it could for sure. Yeah, I would agree. And I mean, I wonder if that would be how that would work out. I have to do some homework on this, but how that would does that create an opportunity from an investment perspective, or does that hurt things? I imagine it's going to help things in some areas,
Hmm.
but which companies would be impacted? I don't have a enough research in the space to start.
Yeah, I definitely agree where it be company specific. But I guess what comes top of mind if you think about company specific is, if anti-globalization is a problem, then the first thing I think about is supply chain, which companies are the best diversified when it comes to, if they are have a global outreach, which are the best to adapt to this as well.
Yeah, yes. And are there companies that are specific to really any country, right? Because
Hmm.
they're going to keep things internal, whether it's the United States, somewhere in Europe, the UK. If an anti-globalization movement is going on, well, then those local companies might have an opportunity. And
Hmm.
I feel
Yes.
like it's so much is just made in China. Maybe that China is then hurt significantly by this movement. Those Chinese companies.
Yeah, I mean, it's
I
definitely
don't
been
know that
different
that's just
compared to back in,
yeah.
let's just say, 2019, where they were a pretty big tailwind. But as far as 2020 and moving on, that really hasn't gone back to the normal how it was a couple of years back. So just seeing how that progresses as well is going to be, I mean, vital to the markets and some companies out there.
Yes, it will. It will. And I'm not sure with what I was just saying as far as local companies and China's impact. I haven't studied this topic to have an opinion, but that's my initial thought. Is that's what I would see. Are there European companies that are going to benefit, and because so much is made in China, are there Chinese companies that'll get hurt by it?
Yeah.
Did you see any other themes or any other areas worth exploring?
I mean, we touched on a majority on my list. Is there anything else that you want to add?
No, I think it's an interesting year. I tend to be bullish on the year, and so I'm on your scale of balancing what was optimism and fear, I believe it was,
Hmm.
or optimism and risk. I'm definitely pretty optimistic for next year, so I'm hoping for and looking forward to a good year next year.
Hmm. Exactly. Yeah, I definitely agree with you, Roshan.
Yeah, for thank you for listening. We hope this helps you in your journey to figure out what to do with investing, where some opportunities are. We hope you can find some things that will do well for you. And if you need help with that, please consult your advisor. Please feel free to reach out to us. We're there to help take control and achieve your goals.